Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing BHP stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. BHP produces iron ore, copper, petroleum, and coal. Iron ore makes up 57% of its total revenue. China purchases 2/3 of the company's iron ore. BHP is the world's largest mining company based on market cap. It is the third largest producer of iron ore in the world. 98% of iron ore is used to make steel. Steel is used in many things such as roads, bridges, buildings, auto parts, etc. The Evergrande Crisis will really hurt this company since China imports 75% of the world's iron ore. Evergrande has $300 billion worth of debt, which is 2% of China's GDP. They are the second largest property developer in China. Property prices have been going up dramatically in China the past decade. Evergrande was able to borrow more money since its asset base kept increasing. This company has been borrowing with the assumption home prices continued rising, but the problem is once house prices stop rising, or even worse, start to decline, then over-leveraged companies like this are unable to pay the interest on their debt. It is not just Evergrande who levered themselves to the gills. Other property developers in China are in the same boat. Evergrande is just so big, they are the company everyone is talking about. Their debt-to-equity ratio is 162%. That means for each dollar of equity, they have $1.62 of debt. This is similar to being upside down on your mortgage. The largest property developer in China is Sun Hung Kai. Their market cap is almost 3 times Evergrande's, but their debt-to-equity ratio is really good at 14%. China's real estate uses 25% of the world's iron ore. As you can see, this situation may be catastrophic for iron ore producers. BHP is the 4th largest producer of copper in the world. Copper supply may start to suffer as demand keeps increasing. 43% of copper is used in building construction, 20% in electronics, 20% in transportation equipment, 10% in consumer products, and 7% in machinery. Copper is more prevalent in EVs than regular cars. A conventional car has 18 to 49 pounds of copper. Hybrid electric vehicles contain 85 pounds. Plug-in electric vehicles use 132 pounds. Battery EVs contain 183 pounds. Not only are individuals buying electric vehicles, so is the government. Lots of states and towns are buying electric buses to help improve the environment. A hybrid electric bus contains 196 pounds of copper, and a battery electric bus has 814 pounds. Think of all those buses. I'm from New York City. There are so many buses. That is a lot of copper that needs to be used to make all those EV buses. Also, the greener we get as a nation, the more demand there will be for copper. An immense amount of copper is used in wind and solar infrastructure. A single wind farm contains between 4 million and 15 million pounds of copper. In 2018, 55,000 tons of copper were used for the wiring inside of the solar panels installed in the US. Globally, 490,000 tons of copper were used in solar panels. That was in 2018. I'm sure the numbers are even higher now, but I could only find the information for 2018. Nothing more recent. BHP is headquartered in Melbourne, Australia, and was founded in 1885, 136 years ago. It went public in 1984 and currently trades on the New York Stock Exchange, Australian Stock Exchange, Mexican Bolsa, Swiss, Deutsche Börse, Johannesburg, Buenos Aires, and London Stock Exchange. Let's get started with the model. This is a large cap company, 133 billion market cap. They're trading at $53 a share, and they have 2.5 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. So they have so much free cash flow remaining, $13.5 billion way up to $20.6 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that goes up dramatically as well, from $3.7 billion to $11 billion. Revenue is the sales for the company, and they had their highest revenue ever in 2021 at $61 billion. This is the company's income statement. The top line is the revenue, the sales. Of the $61 billion of revenue in 2021, $40 billion is from China. So you can see how important China is to this company and this industry. Of the $61 billion revenue, $35 billion was from iron ore, $16 billion from copper, $4 billion from petroleum. You can see the petroleum revenue decreased from 2019. So did coal, that decreased because the prices of those commodities went down. Copper went up 50%. Iron ore was their largest revenue stream in 2019, and that doubled, so it's even larger as a percent of their total revenue. A few months ago, the price of iron ore went up past $200, the first time ever. That's why these companies have been making money hand over fist the past 12 months. In terms of iron ore production, they're number 3. Number 2 is Rio Tinto. Number 1 is Vale. This company is 4th in the world in copper production. Number 1 is Codelco, the Chilean company, which makes sense because Chile produces more copper than any country by far. The Swiss company Glencore is number 2, and then 3rd on the list is a US company, Freeport-McMoRan. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. The cost to mine the products, the cost to ship them, the cost of labor, that's all part of cost of revenue. Revenue minus cost of revenue gives you your gross profit. Below that is their operating expenses, and then below that is their operating income, which doubled from 2018. They've been paying down a lot of debt. They were paying $1.4 billion of interest on their debt, then $1.6 billion. Now it's down to $900 million. They passed through $4 billion of losses. That's mainly from the loss on the sale of an asset and asset impairments. And the bottom line of the income statement is their net income, which is really high, over $11 billion. Have you ever noticed the lower you get on the income statement, the more extreme the growth gets? This only works for companies that are making money. I'll show you what I mean. The revenue grew about 50% from 2018, 40 billion to 60 billion. So it went up about 50%, roughly. Operating income went up 100%, 15 billion to 30 billion. It doubled. Net income went up about 200%. It tripled from 3.7 billion to 11 billion. It's an interesting observation. Let me know in the comments why this occurs. This is the company's income statement. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they generate a ton of operating cash flow, 18 billion up to 27 billion. They also spend a good amount of money in capital expenditures each year, from 5 billion to 6.6 billion. Operating cash flow minus capex gives you your free cash flow. And the free cash flow is a cash that's remaining for you, the investor. So if this was your private business and you own 100% of it, that free cash flow is yours. You can take that $20 billion and do whatever you want with it. So if you took it all and put it into your bank account, that's like paying 100% dividend. But what they did, they used $8.4 billion to pay down debt. You can also buy back stock. They didn't do that. They did in 2019. They bought back $5 billion of stock. Or in the following year, you could reinvest back into your business, so you'd see more in capital expenditures. So it's really up to the company to do whatever they want to do with that free cash flow. They do pay a really nice dividend, so they do give a lot back to the investors. Of course, they have to keep some to grow the business and to pay down debt. This is the equity section of their balance sheet. They have $51 billion of equity. They raised $2 billion from selling their business, and they profited $47 billion from running their business. So it's a really profitable company. Retained earnings is a sum of all your prior net incomes minus the sum of all your prior dividends paid. Let's look at the capital structure. They have 51 billion of equity, 21 billion of debt. They're 71% equity, 29% debt. Their net debt is 5.7 billion. So they could pay off most of the debt with the cash on their balance sheet. And their weighted average cost of capital, which is a blend of the cost of equity and cost of debt, is 7.84%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 245 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $229 billion. We divide that by 2.5 billion shares. And we get a calculated stock price of $91. They're trading at $53, so they're trading at a 42% discount. It's a strong buy according to the model. According to Simply Wall Street, the average analyst projects their revenue to decrease 7.3%. So the way I projected their future revenue, I decreased it 7.3% for the next 4 years. And the way I calculated their future free cash flows, I needed to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers and I divided by these 4 revenue numbers. And that came out to 28%. So I multiplied the revenue numbers by 28%. That's how I got their future free cash flows. Simply Wall Street's valuation is pretty close to where they're trading at. 3 analysts priced this stock and their average price target was $42. This is where the stock has been trading the last 12 months. So you can see it peaked in March and May and also in August. But then the past few weeks it's really declined. And you can see the price of iron ore. That peaked in May at $230, its highest ever. And that's been declining. A majority of their sales are from iron ore. So their stock price movement looks similar to iron ore, but not exactly. If you combine the price charts for all the commodities they sold, you would also have to weight those price charts by how much they sold. So iron ore would have the highest weight. But if you did all that, I guarantee that chart would be very similar to what BHP's stock price looks like. So when you invest in a commodity-linked company, the stock price is highly dependent on the price of the underlying commodity. As you can see, their stock price decreased a lot. In the same time frame, iron ore decreased a lot. So there's a cause and effect with everything. The effect, which is the result of the decrease in stock price, was the decrease in iron ore. The cause of that decrease in iron ore was China's plan to reduce the amount of steel it plans to purchase in the future. And that's due to the looming bankruptcy of many of its real estate developers. But it does appear it hit a bottom because it came back up the past week or so. I don't know if it's going to keep rising, but that is a positive sign if you buy into this stock now. The price of iron ore or any commodity moves the same way as the price of a stock. Supply and demand, it's that simple. To project the future value of BHP, just project the future value of the underlying commodities. Now that's a very difficult thing to do. But that's all it is. It's just connected to the underlying commodity. If I was going to try to explain to you how Microsoft's stock price moves, that would be very complex and convoluted because there's so many factors involved. We have to figure out the products Microsoft will develop, the sales of those products. We have to build into our analysis the competition, the software and hardware competing companies will build. Also, we have to figure out how viable their products will be in 10, 20 years. Will people use regular computers? Will they just mainly switch to smartphones? There's just so many factors and it's endless. With a company like this, it's very, very simple. It's the price of the commodity. They generated so much cash in 2021, they gave a really high dividend, $2 in March, $4 in September, the most dividend they've ever paid. That was 11.4%. If the stock price was trading like it was a few months ago, the dividend yield would be 6 to 8%, which is pretty normal for this company. But since the stock price came down so much, the dividend yield goes up. That's why it looks so crazy high, above 11%. Don't expect an 11% dividend yield in the future. This is probably a one-time thing. And they do have the cash flow. They paid 74% of their free cash flow, so they have 26% remaining to pay down debt or to invest back into the business. And 26% of $21 billion is a lot of money. The reason their payout ratio is 135% is because they pass through a lot of those non-cash losses. So if you strip those out, their payout ratio would look normal. Their industry pays a 3% dividend, they're at 11%, but analysts are forecasting their dividend to come down to 8.4%. The beta is 0.83, so the stock is less volatile than the market. It's gone up 7% in the past 52 weeks. But if you add the dividends in, it's gone up a lot more than that. And the S&P 500 went up 33%. The 52-week low is 47, the high was 82. And the stock is trading below its 50-day and 200-day moving average. 5 million shares were traded on average the past 10 days. Pretty much all the shares outstanding are on float. 7% are held by institutions and under 1% of the shares are shorted. Analysts are expecting their earnings and revenue to decrease, mainly due to the decrease in iron ore. But they may start investing more into copper, which I think is going to start going up a ton. A bullish sign is when a company adds employees. They went from 30,000 in 2015 to 40,000 currently. It did dip from 2016 to 2017, but it's come back up. 2015 and 16 were rough years for companies like this because commodity prices were so low. If you put $10,000 into this company 10 years ago, you'd only have $12,400 today. I did a video of Vale the other day and it was a similar trend. If you put about $3,500 into the stock in 2015 and 16, that would have more than tripled to $12,400. But unfortunately with commodities, a lot of it is timing. Companies like Microsoft, Apple, Netflix, you just buy and hold because over time they tend to go up. With commodities, sometimes you have to time it right, and that's a difficult thing to do. The biggest shareholder is BlackRock at 7%, then Vanguard, then the Norwegian bank Norges, Capital Research, and Elliott Management. Let's look at their financial ratios. They have amazing price multiples, a PE of below 12. That means investors are paying $12 for $1 of earnings. That's much better than the market median and average. Price to sales of 2.2 and price to book of 2.6. And they only have 1.4 billion of intangibles on their balance sheet. Most of their assets are tangible. They have a high return on invested capital of 29%, much higher than its WACC. They can cover their interest payments 32 times. A really good ROE at 22%. They have a good current ratio and quick ratio. They have 15 billion of cash on their balance sheet, 6 billion of receivables, and 4.4 billion of inventory. They seem to be well capitalized. They had 21 billion of free cash flow, 10 billion of working capital, and they paid 15 billion in dividend payments. So they have almost $16 billion of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 9 companies in the same industry as BHP, and if BHP has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So their price multiples are really impressive, much better than average. They have a good current ratio. They're higher than average in ROE. They're pretty much average in debt. And they're the biggest company on this list, and they pay the second highest dividend. So to summarize, I have them trading at a 42% discount, but I do think the stock will come down more because there's a lot of fear over China going to recession. So I would probably hold out. If you bought it now, it's not a bad idea, but you might have to wait a few years. In the long term, I think it's a great stock to hold because you get a really nice dividend. And these mining stocks play such an important role in our society because as we go greener, we really rely on them for the metals they produce. Some people don't like investing in these companies because they tend to be bad for the environment. But that's just really a part of doing business. It's really hard to get around that. I rank their free cash flows 10 out of 10, their revenue 10 out of 10, and their ratio is 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.